Make sure I'm unmuted this time. I've done that a few too many times otherwise. Hi everyone, welcome to the stream. If you've not been here before, this is the Q1 quarterly update for my eToro performance for 2022. On Thursday, I'll be streaming again with a Q&A live stream. So for more like generic questions about investing and my strategy and future thinking stuff or specific stocks and things that you want to talk about, that's probably a better stream to ask those kind of questions on. I'll be taking questions at the end of the stream. So yeah, let's get into it. Okay, so usual disclaimers apply. You can see the blurb at the bottom here. So this is obviously a marketing communication. It's not intended as investment advice or financial advice in any form. I don't know your specific finances and your unique circumstances, so obviously I can't give you any personalized advice. It's for information purposes only, and yeah, I think that's the gist of it really. You can see it all down there. Past performance is not indicative of future results as well. So with the disclaimer out of the way, let's talk about how we're going to go through it. I'll do a quick introduction. Sometimes I'm on the fence about if I need to remove the introduction, but I know that there are a lot of people that haven't watched me before and haven't watched one of these before, so I still have the introduction there. I'll go through my strategy briefly and how I analyze markets, how I find investments, what I look for. And then we'll go into performance and markets. So we'll look at the benchmarks and my performance for the quarter and for the trailing 12 months, since we can't do year to date, and compare that against the benchmarks. Try and do a bit of a dive into the differences and where our returns have come from or our losses have come from, and kind of analyze that. And then we'll look into some of the highlights of the markets through Q1. And then some of the trades that I specifically took during that time or closed out during that time as well. So yeah, that's what we'll be going through, and then right at the end we'll look into the future and into Q2 and the rest of the year, and kind of talk about my expectations, my thoughts, what I'm really looking out for. And after that, we will have the Q&A at the end, so you can ask questions about the quarter or about the stocks that I kind of mentioned, or if there's one that I didn't mention that I was investing in, then you can ask about that as well. Okay. So this is me. I've still not updated the pictures. I really should do that. I think I've said for like 2 or 3 quarters in a row that I'd do that. You can see I'm in a slightly different background. It's very similar, but it's not quite the same. And that's because I moved house. So my desk is no longer there. I don't actually technically even use the same computer that's in that picture anymore. But pretty much the rest of it is the same. So I'm trading at my setup all the time. I have 2 screens dedicated for charts pretty much 24/7. So even when I'm doing things that are completely unrelated to investing at my PC, I will be seeing what's going on with markets, which is useful because sometimes you catch things. I've been on eToro for a pretty long time now. So I started investing about 11 years, a bit over 11 years ago now, and I'm approaching 10 years actually on eToro at this point. I went full time on eToro as a popular investor in 2017. I quit my job. Previous to that, I was working in the gaming and events industry, so esports manager, and I was working in logistics and event management before that as well. I'm pretty much self-taught. I can't really say that quite so much these days because I have read some proper official sounding books, and taken some exams to prove that I do know something about how the markets work. But for the most part, especially my strategy and such was really built through trial and error and a lot of practice and teaching myself using Google back in the day, and really that's where I learned how to read balance sheets and everything else, and kind of developed my investing style. Since joining eToro, my compound annual growth rate is over 40%, which is pretty pretty high, I think, by most people's standards. That obviously comes with risk, but it's a number that I'm pretty proud of, and I would very much like to keep it as high as I can, really. So, I'd very much like to keep it above 40% if possible throughout my career. Pretty big ask, but that's what I would like to achieve if possible. Yeah, shoot for the moon and maybe you'll land in the stars, I guess. That's the theory. In terms of, I guess the last thing really to mention is sort of to do with my approach. So we'll touch on this in a second on the next slide. But I consider my approach to be kind of led by thinking forward about the future and by ethics. So I really like to kind of take a futurology sort of approach to things. So really, futurology is future studies. So trying to predict what's going to happen in the future, I guess, and the different potential scenarios that may happen. So I do a lot of theory crafting and things for my investing strategy. Likewise, I'm very concerned about ethical things. So that's everything from pollution and looking after the environment to making sure that staff welfare is good at companies, making sure that products that are produced are actually good for people, that there's no exploitation. And stuff for as much as far as is possible when investing. Obviously, it's a grey area. There is no definitive line you can really put down the middle to say what's good and what's bad. But I try my best to stay on the good side of that. So that means no investing in fossil fuels and such. And yeah, that's me. So as I said earlier, I've been on eToro a long time now. Over 8 years. My CAGR, here's the actual specific number, 40.74%. That was accurate as of the end of last quarter, so I haven't calculated it since then. Assets under copy was over 100 million. It's actually just below 100 million now at time of recording, so who knows, maybe one day in the future I'll be copyable again. Likewise, copiers I think has dropped below that number now, but it was over 22,000, and my lifetime total return is over 1,500%. So not not too bad for 8 years. I say lifetime return, I mean lifetime return on eToro. So I'm going to talk a bit about my my strategy and really what I'm looking at and how I find investments. So they don't necessarily go in order of the icons that you see on the screen, but generally speaking, it really starts with identifying future trends and what's going on in the world. Sometimes it can be current trends as well. It doesn't have to be a future trend. Sometimes you've got to be reactionary and look at what's going on right now and things that are unfolding in front of us. So that can be anything from vertical farming through to maybe some space stuff, or looking at the kind of advances in semiconductors, renewable energy, and the transition that's going on there. It could be to do with all of those sorts of things, and everything in between, gene editing and such. Those are the areas that I like to invest in. I find them the most interesting, which means that I tend to spend far too much time looking at them in my spare time as well. And because I'm more passionate about those things, I think I do a better job at researching them. On that note, I'm also very product orientated. And when I say product, I mean it can be a service as well as a product. It can be, something a bit more abstract than just a product, like something that you would buy off a shelf. But those are things that I really focus on a lot as well. So my belief is that generally speaking, consumers tend to seek out and find the best products that are available. It is at the end of the day a market, right? So just like normal markets kind of strive for efficiency, so do real life markets. And so people try and find the best products that they can. So if you can identify those products earlier than other people, and how good they are, then as long as the rest of the company kind of stacks up behind it, that's a good indicator of something that may be a good investment. And of course, being an early adopter really helps you kind of keep ahead of everyone else, I guess, and perhaps reap some of the benefits as society catches up. Uh, Next up is fundamentals. Fundamentals, obviously, I think is a pretty broad term, really, these days. But for me, that really means the financials of the company. So looking at the balance sheet, looking at the income statement, cash flow statement, those three things really are at the core of it. And then a lot of the different ratios and numbers that you hear people talk about all the time, everything from price to earnings and price to sales ratios, the beta of the stock compared to its, well, the beta is essentially its volatility compared to its peers. So all of those sorts of things really fall under fundamentals for me. Generally, for me personally, since I invest more in growth companies, I'm looking more towards revenue growth and things like that. And actually, a lot of it is also contained in sort of upcoming product launches and analyzing capex spending and things as well. And also acquisitions that companies make, mergers and acquisitions is also really important on that side of things in growth investing. I'm also, as I mentioned, looking at ESG stuff all the time. So that covers quite a broad range of things. Everything from how much plastic pollution there is. As I mentioned earlier, it's the same sort of things. Are they really treating society in a good way overall? That means everything from their consumers and their staff through to the environment and everything else in between. So for me, that's really important. It does mean that you will take higher risk. Essentially, these stocks carry a bit of a premium because people like me like them, and if they carry a premium, that means that they're less well valued. So theoretically, if you're an ESG investor, you shouldn't be performing as well as underlying markets. I think that's as much as that is true, I also think that it's very possible to be an ethical investor and still outperform the markets as well. So that's what I strive for. I don't like to think that my ESG standards are holding back the portfolio too much. And I don't generally think that's the case. A lot of the time, they're quite progressive things. You could say that ESG itself is something that we're kind of early adopters of compared to a lot of the world. The next thing really is portfolio fit, and what I mean by that is essentially how the instrument that we're looking to invest in compares with the rest of the portfolio and how it complements or perhaps doesn't complement other things in the portfolio. So looking at the correlations that exists in the portfolio and where potentially there could be even dependencies on other companies as well. It can be looking at geographic risk. So looking at where companies are selling their products, where their revenue is coming from, if it's from a single company or lots of companies. All of these things kind of fit into that sort of realm, in my opinion. So really, I guess maybe I should change it to risk to some extent, but essentially it is how well this fits into the portfolio, what kind of allocation we should give it. Following that, there is there is sentiment. So sentiment is something that's very difficult to measure, really. I think in any sort of an accurate way, it's not something you can necessarily put a number on. But I do think that it's very important. I think, especially in the past few years in markets, we've seen the ability for mainstream investors and consumers to drive prices on certain types of instruments, and it's not only that, but also everything around the kind of culture in the company kind of falls into this category as well. It obviously falls into ESG too, but the the difference in how you treat your employees and how you kind of lead by example can really make a big difference in how company performs. There's actually quite a few studies that point to the culture of a company being directly correlated with its outperformance in the market. So a company with good company culture, where people enjoy their work and they make ethical decisions, is also kind of part of that, I think. And it obviously helps attract more talent to the company as well, which is increasingly important in terms of labor. And then finally, we have technicals. And this one is at the end for a reason. It's not something that I use too often. Technicals are really, I think, better suited to more short-term trading, and also, they do drive crypto markets a lot more than they do in traditional markets. So, that's where I tend to use technical analysis a little bit more. I do think that there's obviously some insights you can get, but most analysis really is regressive, so it's kind of looking backwards. But certainly some of the kind of mean reversion things around moving averages and parabolic stop and reverse and things like that are what I use to try and look at things from a technical perspective. Okay. So Q1 portfolio themes. So this slide's really geared towards explaining how we were positioned going into Q1. And obviously, it's quite a lot to try and fit into just a few categories on a slide and to talk about, because we have quite a few stocks in the portfolio. But really, this is the way that I was positioned as we were heading into the end of, well, not so much into the end of last year, but into the start of this year. So I'll start off with renewables. This has obviously been a staple of my portfolio for some time, but there was a period in 2021 where I had reduced exposure quite a bit, especially to the solar side. And I started to rebuild that in Q3 and Q4. And by the time we got to Q1, it was pretty large exposure again. And I also added to it through the quarter as well. And the reason for that really was the energy crisis that was unfolding in Europe and how much oil and gas prices had been increasing throughout that time period. I would love to claim some sort of credit for predicting the Russian invasion of Ukraine, but that really wasn't such a major part of my decision for really pouring money into renewables early. And also, I think if you actually look at the performance of them since then, it's actually not really that significant compared to the overall markets anyway. But it is something that I see being a problem for a pretty long time to come still as well, not just in Europe, but even in the US. There were a lot of blackouts and things last year, and there's an awful lot of innovation going on in the space of the grid and renewables at the moment. If you haven't read my article about virtual power plants, then that might be worth checking out on eToro, which kind of covers part of what's going on in that space. Utilities, kind of related to the first thing, are also a big part of the portfolio as we went into the quarter. That means everything from some of the waste management companies like Veolia and water companies, and we even have SSE, which is a company that does have some fossil fuel exposure, but they are also the UK's biggest spender on new renewables as well. So in my opinion, it does kind of balance out, and that's one of their hydro plants in the picture as well up in Scotland that they've been working on recently, giving some upgrades to. So yeah, the point of this really is for some dividends and a bit more security in the portfolio going into the new year. I was well aware that interest rate hikes were coming. So I had been building exposure to this. I'll cover a little bit further down some of the other stuff that we're doing to protect, but really this kind of overlaps with the category below of hedging and dividends. Semiconductors and tech, I mean, this is really my bread and butter and what I love investing in. I've really built a lot of exposure to companies like Ubiquiti through the quarter, added some exposure to Sony, as well going into the new year. AMD obviously is one of my long-term plays. I added a lot to Garmin going into the new year as well. Actually added that a bit before that, even going into Christmas as well. So, there's quite a lot that kind of fits in this category. I still think that gaming is a sector that I think is a little bit undervalued at the moment. And I certainly thought that going into the quarter as well. And the screenshot that I have included there is, you may think is a photograph from something in real life, like maybe some sort of fake terracotta army or something. But in fact, that's actually just rendered in real time in the new engine by Epic, which is part owned by Tencent and part owned by Sony, along with a few others. They actually just raised some more funding recently that Sony joined in on. And that's a big part of why I own Sony. It's being used more and more in the movie industry, music industry, all of these things. And I think it's really probably the future of any sort of video-based media is going to be related to some of the big game engines out there, like Unreal Engine. So that's why I included that. I thought it was pretty cool. Little anecdote. Transport is the next thing. So this is, again, a very broad category. I've got a picture there of the new Arrival bus, which they will soon be producing in the UK, hopefully. I saw the Arrival van just a couple of days ago. Maybe I should have updated this picture to show it. If you have a look on if you have a look on my Twitter, then you'll see that. I'm not sure if my Twitch is trying to play ads while I'm doing this. It just gave me an alert, and I've never seen that before, so I hope it doesn't. So yeah, transport, very broad category, covers a lot of things, including rail, as well as EVs and some of the kind of things in between as well. So even ABB, who provide a lot of infrastructure around rail infrastructure in Europe and around the world as well, would fit into this category. The rail stocks are useful because, again, going into what's been going on around the world with a lot of the logistics problems, the supply chain problems, they've been doing very, very well. They're also generally a bit cleaner and greener, and they pay a healthy dividend. So there's a lot to fit into this category and a lot that we could talk about, but it was definitely one of the categories that I had a lot of exposure to going to the start of this year. Obviously not forgetting Ford, which was and still is the biggest holding in my portfolio. Hedging and dividends. So I think I've almost drilled this point home now that this was a big concern of mine going into the quarter. If you go back a few of my presentations and look at them on YouTube, then you'll see that I was very much looking at building some protection into the portfolio through mainly through dividend yielding stocks, but also through some hedging positions. And I did hedge a bit more towards the start of this quarter rather than recently. Unfortunately, I would have preferred, obviously in hindsight, I would have kept those open a bit longer. But really, dividends is the core thing. And again, here the picture is Unilever's suite of products, a company that I get sometimes a little bit of backlash on for investing in when I describe myself as ESG, but I think if you look at some of the things they're doing around reducing plastic waste and trying to bring all of their brands up to date, there's a lot going on there, and they're definitely moving in the right direction. And then last up, we have industrial and commodity. Picture there is of Nucor. So this is a steel company that I was looking at late last year, and we built up some exposure to go into the quarter. I added more exposure through the quarter, especially when the conflict in Ukraine started, and obviously they benefited from that. They produce fully green steel, which is really, really cool. I could talk about them for quite some time at length, and some of their competitors as well, actually. They're actually, I think, at the moment on Seeking Alpha, I saw this yesterday, they're ranked second, or I think it was second, the second highest dividend stock for safety and performance and stuff by quant ratings on the entire website. So out of everything in the US, yeah, they're looking pretty healthy right now, I would say. And yeah, they've performed well. Industrial, of course, is made up of a lot more than that in commodity. I don't really tend to invest in commodities directly, and that's still the case. I don't really have any of them at the moment. But I do have a lot of companies with exposure to industry, everything from industrial automation like ABB and Siemens, who build a lot of infrastructure. All of that sort of stuff is really what I would lump into that category. And again, these are stocks that are generally a bit more stable and a bit more kind of bolted down in terms of their price movement. They're not quite so volatile. But I think when you're looking at the kind of market conditions we were moving into in January, I definitely wanted to make sure that I owned some of these big guys that benefit from large infrastructure spending and such. So on to performance. Hopefully you haven't all fallen asleep yet. Okay, so there's no real nice way of putting this. I think it's pretty clear from this that I broadly underperformed all of my core benchmarks. You'll notice that I removed cryptos from this slide. I used to have a section with cryptocurrencies in it. The indices that I was using have again kind of changed in how accurate they are and how relevant they are as well. I have very little exposure to cryptocurrency at the moment in the portfolio. And again, I had very little exposure going into the year. I reduced it massively last quarter, so I decided to take it off the slide because I felt like it just confused things, if you're wondering where that went. Let's talk about the US first. So the S&P 500 obviously is the best performing of the major US indices you can see here, the benchmarks that you can see. And that's really down to the kind of constituent parts of the S&P 500. The S&P 500 out of the three that are listed here have by far the most exposure to oil and commodities generally, oil and gas and coal and everything, copper, steel, wheat, all of those sorts of things. So it's generally kind of considered to be a bit safer than both the Russell and the NASDAQ and less volatile. So it's not too surprising to see that outperform, especially when you consider that the change that we saw in interest rates in January when they were first there was that first shock to the market when Powell announced the interest rate hikes and the kind of plans for what was coming. That really was, a bit of a death knell to some extent. I wouldn't say a death knell, that's maybe a bit extreme, but it was certainly a bit of an alarm bell that was going off for investors who are investing a lot of the riskier growth stocks. Growth stocks generally are much more capital intensive. They tend to have much lower revenue, and certainly an awful lot of them aren't even profitable, and really they're looking to kind of grow before they monetize. And have high debts as well. So interest rates are really, really bad for those things. So that's something that obviously is really what's behind the underperformance by the NASDAQ and the Russell over this time period. The Russell is full of much smaller companies, so there's a lot less safety there generally. A lot of them are very disruptive and hoping to grow, and they're kind of seen as growth stocks. Some of them are just small, and if they're small, then that means that they have kind of less access to credit markets and things to try and protect against inflation. So that's really why they perform like that. My performance obviously is much more tied towards the NASDAQ and the Russell, so I would not have expected to outperform the S&P 500 at all during this period. So I'm not too surprised that we're worse than 5% down if the S&P is down by almost 5%. But I was hoping that it would have been higher, but we'll go into the causes for that shortly. Looking at Europe, when I said that the S&P had a high exposure to fossil fuels and such, the FTSE is really that, but times 100. Pretty much every major oil company in the world is in the FTSE 100. The same goes for mining companies. All of the big mining companies pretty much are listed there. So they really did very, very well out of the war. That's really, I think, the reason that we can see that outperforming. The other thing that's worth noting is that while it does say plus 1.15%, as you can see with the little asterisks down there at the bottom, it's not adjusted for exchange rate fluctuation. So actually, in real terms, since our portfolio is held in US dollars and measured in US dollars, it didn't actually perform as well because the pound lost against the dollar during the time period. And the same is true of the two below it for the DAX, which is the German markets, and the Stocks 50 as well. So both of those were also down more than that number you see on screen if you're measuring it from the perspective of US dollars. So that's something pretty worthwhile to note, really, because it does mean that I did actually outperform European markets, excluding the UK. And I do have a lot of exposure to those markets, which also helps to explain to some extent where some of the kind of underperformance may have come from with regards to the portfolio's comparison with the NASDAQ 100, which is my main benchmark, I would say. So yeah, I think keep that in mind when you're looking at these numbers. For the trailing 12 months, things get substantially worse. I mean, this just looks awful, really, at first glance. The only thing that I outperformed here was the Russell 2000. So yeah, that's not a great start, really. Well, the DAX as well, marginally. Yeah, so diving into this, I think if you look back, the best way really, if you want to understand this fully, is to go back through my previous quarterly updates. But if you go back and you have a look at those, I think what you'll see is that there are a few specific events that happened with some of my positions that really caused most of the underperformance. Most of my gains last year were made during Q1. And after that, the likes of Peloton, for example, Etsy towards the end of the year, and a few others really dragged the portfolio performance down. Even though I reduced exposure to Peloton a lot during that period, the damage was done to some extent, and we took a pretty big hit in the last part of the year. The other thing is that again, renewables really underperformed last year. The wind renewables especially did very well. Hydrogen renewables were hit very, very badly towards the end of the year as well, as we approached January, which is when they then got hit much harder. So yeah, there's quite a lot that kind of affected us during that period that led to the underperformance. So it's it does pain me a little bit to look at my number in comparison with the Nasdaq here. But we did outperform. Well, we didn't outperform, but we were essentially on target with the Nasdaq last year. So I'm not too upset with it overall. I think when you're looking at relatively short time periods, like a single year, it's kind of easy to start getting upset or overly jubilant about performance. But really, what matters is long-term performance, and I still think that we're positioned in a way that's healthy and sustainable and very managed in terms of the risk perspective. And the other thing to mention, of course, is that the FTSE is purely just because of the recovery from oil and gas. Just going back to that slide, pretty crazy numbers. I don't think I've ever witnessed the FTSE 100 increase by so much in such a period. So Q1 market highlights. What happened during the quarter? Oh my days, what didn't happen? That would almost be an easier question. The obvious one is the invasion of Ukraine. I'm pretty sure that I said about 4 days before the invasion started that it was never going to happen and that Russia would be crazy to do such a thing. So I'm not going to profess to be some sort of a crystal ball fortune teller over here, but it certainly made a big impact on markets. Probably the biggest impact on markets, even more so than interest rates for a long time. Although I would say that interest rates are what are driving markets now, much more than the conflict. Certainly US markets, European markets are definitely impacted by the conflict. So this obviously had knock-on effects throughout the economy, and really when you look at the other kind of tiles that I got in this slide, they all apart from interest rates, they're pretty much all connected to this, and the COVID lockdowns in China. Apart from that, they're all related to this. So the impact it had on commodities, wheat is what's obviously in the picture. We all know that Ukraine exports a lot of wheat to the Middle East and to Northern Africa by now, along with many other countries. Wheat's used in all sorts of things. Why does stream keep going? Yeah, I don't know why ads are turned on. I do apologize for that. I'm really hoping that the ads don't appear don't appear in the YouTube version. I may look and see if I can find a way of turning them off, but I don't know how. I'll wait. I'll try and fix that for next time. I'm sorry about that. Yeah, I don't know what's happened. They never used to be on, so something's changed. But I can't really look at it midstream, I'm afraid. So yeah, just check back on YouTube for the 2 minutes that you missed. I really am sorry about that. Okay, yeah. So what I was saying was commodities were obviously impacted very dramatically, and it's more than just wheat, which is the main thing that talks about, and then oil and gas from the Russian perspective that everyone was talking about. There's obviously also really big impact on things like semiconductors. Some of the gases that are used in semiconductors come from Ukraine. Even for things like heat pumps and stuff come from Ukraine. Quite a few chemicals come from that region. In terms of metal, certainly for Europe, they're one of the largest suppliers of steel. Steel is used in all sorts of different things, including cars and batteries and everything else. So the price of nickel, for example, went up because that needs materials that come from Ukraine. So really, there were almost no commodities that weren't affected by this. So I think, yeah, pretty dramatic impact on markets, and then a dramatic impact on stocks as a result. So companies like Ford, for example, had to halt production for a brief period on their vehicles. There's also the European energy crisis that kind of stemmed from this. So where the price of oil and gas went up, Germany, Hungary, and several other countries in Europe are incredibly reliant on Russian gas. It's another big reason that I'm very bullish on my solar and wind positions, because obviously it's just not viable to stay like that. The picture that I used for this energy crisis, by the way, is a nuclear power station. It's actually the largest, I think, nuclear power station in Germany, which is due to be turned off in December. That's when it's due to be decommissioned of this year. So yeah, Germany needs to move pretty quick, or change their mind. It's yeah, there's so much disruption that's been caused by this. It's really pretty crazy to think about. It's been like a race across Europe to try and source energy from elsewhere. Gas in particular is really the one that hurts the most, much more than oil, because gas is used for responsive grids. So when there's peaks in demand in the grid, so everyone is watching TV and they'll go and make their dinner at the same time, that's when gas is turned on. So if you want to do your part, have your dinner at like midnight, and you'll be helping the grid, and you'll be helping your country. But yes, very substantial impact. And again, our wind and solar and hydrogen plays benefited from this happening. And it feels weird to benefit from a crisis, but in this case, I'm not too upset by it, because at the end of the day, we're trying to help fund this transition away from situations like this happening. And I would much prefer that we had moved away a bit sooner, really. Companies withdrawing from Russia. So some companies had massive exposure in Russia, and a lot of assets there, which is really the worst thing. It's not too bad if you're a Microsoft or someone like that to say we're going to stop selling products in Russia. But if you are a company like a furniture company or something like that, for example, then it's much more difficult, because you have not only do you have inventory over there that you would very much like to sell or get rid of and turn into cash that you can then leave the country with, but you also have a lot of buildings and leases and machinery and things like that. So a lot of companies were really hit quite hard by this. Some of the car companies in particular were hit hard. If you think about how much money a big car plant is really worth, it's yeah, they're not cheap, not cheap things to be holding on to and allowing to just depreciate without you producing anything from it. So some companies got hit very hard by that. We didn't have too much exposure to that, luckily. A little bit through Ford, but not too much. Russia isn't really a big market for them. So um, yeah, a big thing that happened, but it didn't really impact us too much. China lockdowns and Europeans opening up their economies a bit more. So obviously COVID is still there, and we're still witnessing China going for this zero COVID policy. That's now started to affect supply chains again in China for some companies. I was listening pretty intently to the earnings call of Enphase late last week, and they were talking about it there as well. That it hasn't impacted them yet, but they're not sure if it might still impact them at some point because of how bad the situation is over there. And obviously, COVID is still around, is the other thing. So it remains to be seen if there could be a new variant or something that hopefully that doesn't happen, but there could be another new variant that does cause more damage to the economy and slow things down again and disrupt society even more than it already has. So that's definitely something that I'm still paying attention to and has been kind of unfolding through the quarter. Mainly what's happening in China more so than what's been going on in Europe, with it kind of reversing a bit. But yeah, big thing to be looking out for. And finally, we have interest rates. I've talked about it a lot. It looks like they're going to be accelerating. How quickly these come to hit the markets, and that could be a good thing or a bad thing, which is a very nondescript answer. I'm sure most of you are pretty frustrated with me even saying that. But essentially, they're betting that they can lift them faster and that it will much more rapidly impact the inflation rates that we're seeing, affecting everything around us and the prices that we're paying in shops and for our bills and everything else. The danger of an approach like that is that it could actually shock markets quite substantially, and we could see people, very rapidly stop deploying capital and stop spending as rates go up. They'd much rather be saving their money, and it means that things like equities become even less attractive, because if rates go up really quickly, then and you were sitting in a stock that's likely to yield you 5% in a year, all of a sudden you now have potentially opportunities in bond markets and such to get a return that's similar to that, that's a much safer return. So yeah, the interest rates have definitely been a big thing for this quarter, and I think they will be for the rest of the year as well, and seeing how that unfolds. Looking at trading highlights, there's a few that I could highlight. Too many really to fit onto a single slide, but I did my best. So I think the first thing that I wanted to mention was the rail companies. They did really well through the volatility. Good dividends, pretty stable and holding on to most of the rail traffic. Even though supply chain issues in the US have eased, the kind of increasing demand for commodities and exporting commodities means that they're doing more stuff, moving things around to and fro from ports. Commodities makes up a pretty big chunk of rail traffic, so that was nice and useful. On the utility side of it, we did really well with SSE and TRIG, which is the Renewables Infrastructure Group. They basically just own wind farms and solar farms and a few other things in between. And of course the likes of Veolia and Aconia. I can never remember how to spell it or how to say it, so sorry if I've butchered that. But yeah, these companies are good and stable, and they've been providing us with dividends. And if you look at the drawdowns of the positions there in my portfolio, at least the ones that I haven't cycled through yet, you'll see that they've been doing pretty good for us throughout the year. And if you look at a chart, it's pretty flat which is good. That's what we were investing in them for. We wanted it to be flat and give us some dividends. And the other thing is that it's really holding on to our position, holding on to our money in something that isn't cash that we can then use to cycle into something else later on if we want to. And it's not that they don't have growth ahead as well. I think that these industries have got actually quite a lot of growth in them. There's a lot of innovation taking place. The growth stocks. This is the sad one. Yeah, I mean, Netflix was brutal. Peloton was brutal. Etsy has been pretty brutal as well. Shopify was very brutal. Thinking back to Q1 earnings, really it was Netflix and Shopify were the main ones that everyone looked at. Obviously, we've just had Netflix's earnings for Q2 recently, and they were equally brutal. So the good news is that I had very little exposure to Netflix going into that, and to Peloton, and to Shopify actually. They were all small positions in my portfolio by this point. I cut most of my Peloton last year after their first brutal earnings. But I did hold on to a little bit, and in thinking, we're already down by so much, it doesn't really hurt to wait and see if they can pull out a rabbit from a hat. But they did not. So yeah, that hurt us. Netflix hurt us as well. But as I said, the good thing here is that I took pretty decisive action on these kind of stocks very early on. I basically cut exposure to all of these. I don't have any of these in my portfolio, or really very many things that are similar to them. Well, I do have some Etsy still. But yeah, by getting out when we did, really pretty early in January, as earnings were unfolding, we avoided the losses that came later down the line and that we're seeing coming in through earnings at the moment for the likes of Netflix especially. It remains to be seen how the others will do, but yeah, as I said, there's a lot of things that are behind these moves. At the end of the day, some of these are kind of seen as more luxury products, consumer discretionary rather than consumer staples. So these are the things that people will cut spending on when they feel like they want to tighten their belts and save money because of the concerns around recession and such. Renewables was also wobbly, to say the best. You would think that solar and wind would have done incredibly well during this period, given what's been going on in the world, and hydrogen as well. But that's not necessarily the case. Solar has certainly started to turn around in a good way now, and I think when you look at solar, it's done quite well through the period. Wind has done really quite poorly, and it did poorly last year. And last year it was mainly due to commodities, and this year it is mainly due to commodities. If anything, they're actually starting to suffer now from their own success in that they've got such big order books and these deals for new wind farms, for example, especially that were signed years ago and paid for years ago, they're now going to fulfill those orders and actually deliver those turbines for wind farms, and discovering that the price of the raw materials that go into it, the price of labor, the supply chain issues have really added so much to their cost that there's no margin left for them. So SGRE, for example, Siemens Gamsa, they really were one of the biggest hit by this, and that was probably the biggest pain I felt at the start of the year was SGRE. I removed all exposure to them. I'd already cut it back last year because I could see that they were starting to struggle with management. They actually just sold off part of the business to someone else that's actually in my portfolio, and now I've completely forgotten who it was off the top of my head. But yeah, there's been, I think it was SSE. Yeah, SSE bought it. So yeah, Wind's really had a very, very tough time because of the sensitivity to commodity prices, whereas the commodities that are related to solar have not been affected quite so badly, and solar is much more able to kind of ramp up to meet the demand that they have, where wind has been too slow to ramp up, so they're just getting increasingly large backlogs. Hydrogen is just kind of in the middle, really. The problem with hydrogen is that there's very little out there in the hydrogen world that's that profitable at the moment, or profitable at all. So there's a lot of debt in that industry. So really, that's the thing that's been kind of adding to volatility there. And obviously, as we've seen, the ebbs and flows of the war and of the supply chain situation and semiconductors, which also really affects these industries as well. That's all kind of played a role in the volatility here. But generally, the picture I think is still looking good overall. And I'm still holding my exposure to the wind stuff through VWS and Orsted, despite their problems, because in the long term, it looks really, really good for them, especially when you think about the kind of growing services side of their business, rather than just building and delivering wind turbines, the services that they then provide for all of the wind turbines that are out there in the world. Last of all, we have semiconductors. Again, Chinese lockdowns have affected these. Concerns over Taiwan is the really big thing. So, where obviously there was the invasion of Ukraine, a lot of people were very fearful about what China might do, and that they might kind of take a bit of an opportunist moment to maybe do something in Taiwan. And as you know, hopefully, Taiwan is responsible for over 90% of the world's semiconductors, certainly the good ones. The cutting edge stuff is all based over there with companies like TSMC, one of the most valuable companies in the world. And they produce semiconductors for almost everyone. Most of the companies that I've got listed down there use TSMC as their fabricator. So there's been some concerns there, and that's led people to kind of move a bit of money out of the market, despite the still increasing demand and that there is still a backlog. The other thing is we saw a bit of a slowdown in the PC market demand and related areas, because the kind of work from home thing is, everyone who needed a computer has got a computer now, really. And the same with offices. We may see some sort of a kind of resurgence as demand in offices goes up, but what we're seeing on the server side is really encouraging. So companies that have good exposure to the server side of the semiconductor market are looking very, very good, and that's why I'm still very bullish on AMD especially, but also the others that you can see listed there. They all have exposure, but so again, big impact on the portfolio. Those were some of the positions that I was, moving around and shuffling in through the quarter. Looking ahead, I know this feels like I don't know about you guys, but to me this feels like a longer call. It's just like there's so much to try and talk about. Looking ahead, I don't want to dwell on the topic of interest rates forever, but it is unfortunately going to be like the key two words for the year, I think, are interest rates. As I mentioned, we may see the kind of accelerated ramp in interest rates in the US start to cause some problems potentially, or it may well start to stimulate the economy, and well, not stimulate the economy, but it may well lead to markets cooling off much more quickly, and inflation as a result cooling off more as well, as spending decreases a little bit. I guess one of the key concerns really that we're looking out for is how it affects growth, though, and if we do head into a kind of recession of some description. I think it certainly outside the US is where I see that risk being much higher, in the Eurozone especially. And China, because we can't forget that China still hasn't really recovered from the housing situation they had, and obviously COVID is still hurting them over there. Which ties in very nicely to the next point. Commodity markets and supply chains. It's starting to look like this Russian invasion of Ukraine may drag out for a pretty long time. And if it does, then we are going to see that still playing a big role in those markets, and those kind of increased prices are not going to be easing too soon. So that's a pretty sad situation, obviously for Ukraine especially. But at the same time, we are starting to see certainly Western Ukraine start trading a bit more freely again, and start production a little bit more again in some of their industries. A lot of the wheat is now going out via Poland to make its way down to Africa. So, this will help a little bit to ease those problems. As for China, I think trying to predict what China's going to do, or if they're going to give up on this zero COVID strategy, is something that's really, really difficult to know. So on that front, really, it's just something that we just have to monitor. I don't think it's going to be very easy to position for that. The good news is that we have no exposure to China directly in the portfolio at the moment, or even indirectly in that much outside of the solar and semiconductor industries. And the last thing is just the invasion of Ukraine, really what's going to happen. As I've said numerous times, it does affect a lot of things. Travel and leisure is one of the sectors that has done reasonably well through the start of this year, as I said, as it opens up more in Europe. And certainly in the US, which is obviously quite far away geographically from this conflict, and their economy is still looking a little bit more resilient. Travel and leisure are already starting to pick up there. We've got some big earnings this week from Booking, and I think did we just have Expedia? And yeah, it's looking pretty good there. And it's actually one of the sectors that I'm considering adding more exposure to. I do have some exposure to Airbnb, who have earnings this week, and obviously to theme parks as well. That also most of them have earnings this week. But yeah, it's another area to be looking at, I guess, is what's going to be happening over there. To me, it looks like it's starting to stabilize a bit, and if anything, perhaps pushing back. But that in itself carries all sorts of risks. So yeah, I think everyone's watching what happens in that situation, and hopefully it just ends soon, and hopefully Ukraine get their land back as well, in my opinion. But right, that's enough politics from me. On to the Q&A. So if you haven't typed your question yet, start typing it now. While you do that, I'm going to go through some social media stuff and a few other bits and bobs. So first of all, I want to make sure that if you are following me on social media, that you're following the correct me. Instagram especially is where this is bad. There are a lot of people trying to scam people, and sadly, it is in the hundreds of thousands that have been stolen from people who think that they're speaking to me on Instagram. So if you're on Instagram, just follow me, and then be careful. Check the spelling. My name is Jaynemesis pretty much everywhere. So if it's not spelt like my name, then it's not me. So please be careful out there with regards to who you're chatting to. Be vigilant. Report them. You don't need to tell me about it. Trust me, everyone tells me about it. I get about 100 messages every time a new account pops up on Instagram. As I said, Instagram's the worst for it, but by no means the only place. So there are occasionally people impersonating me elsewhere as well. So just watch out for that. And yeah, now I'm going to try and answer some questions for you guys if you have any. I'm going to try and scroll up a bit and see which ones I missed. Okay. What do you think about Amazon's stock, and where do you think it's going from here for the next 3 years? I'm a little bit concerned about Amazon, actually. I don't hold any in the portfolio. My exposure to I guess online spending is really more through Etsy and Visa, actually, who had a very good earnings, actually. I think that really the online, the kind of shopping side of the business is always really very low margin. They're spending a lot of money trying to expand out their kind of logistics side of the business, which should help reduce costs a lot for them. But also they've got some headwinds there. They partnered with Rivian for their trucks, and Rivian has been really struggling to actually deliver. And I'm a bit concerned about what's going to happen there, not to mention that Amazon is an owner of Rivian, so they've lost a lot of money on that investment at the moment, and I think that could get worse, potentially, because Rivian aren't looking too great at the moment. outside of that, like, I mean, really, it's AWS is the main thing. And when you look at their growth in that market and their dominance in that market, and then compare it with both Google and Microsoft, they're really starting to lose ground pretty rapidly. And I think Microsoft is going to be the big winner there. They look like they're the ones with the most growth and the most momentum, and certainly with the most related products that are really helping them, win those that cloud business from large corporations. So yeah, Microsoft's who I favor in that space, and also, like, Microsoft's got the gaming angle as well. Yeah, I think Microsoft are just much better positioned if you're looking for cloud specifically. If you're not looking for cloud, yeah, I think there's better picks out there than Amazon, to be honest. I haven't held them for a while. I don't think I plan to currently. There's a lot to go on there. There's a lot of work that needs to happen there, I think, to kind of improve things. But I can see it slowing and turning into a much kind of slower growth stock. I know Felix Falax is going to have a question for me at some point. I live in hope. Thank you for your work. Been very satisfied despite what's going on. During the 2008 global financial crisis, when the Fed printed money, the S&P did not give any returns for 3 years after that. Do you think we're headed in a similar trend for the next 3 years or so? No, I don't actually, to be honest. I think we're in a really different situation. I mean, the global financial crisis, the first thing I'll say is it was global. And I think if you look at as much as there's a lot of a lot of companies, a lot of countries that are in a very bad situation right now, there are some that are looking much more resilient and much more healthy in terms of their economies. Obviously, there's still going to be, we live in a global market, so everything's connected. So you're still going to have markets fall. But I think to some extent, even the FTSE, you could argue, is a demonstration that that there is still some growth out there to be had in certain sectors and certain kind of demographics of the market. The other thing is, I guess, the duration of it is the main thing that I kind of object to. 3 years is a long time. The average bear market does not last that long. I don't know. I think there's an ad running. Oh no, you recently ran an ad. Man, I really hope I didn't just cut that off with an ad. Okay. Where was I? I've entirely forgotten what I was saying. I'm also trying to scroll back up to the question because I scrolled down to see if you had said anything. Yeah. So the 3 years, the average duration of a bear market is not that long. It's less than 3 years. It's actually closer to 1 year. So I would say that that's pretty unlikely. And when you actually kind of look at where we are with that in mind, we're a good 6 months in now, and I think really when you kind of look at things, there's a lot going on to cause this, which is a good thing in some ways, because it means that if there's a lot of things that are causing this, like, for example, supply chain and semiconductors and the war in Ukraine and the tensions in China and the shortage of labor, all of these things aren't going to be bad forever, right? All of them, well, most of them are on a trajectory towards resolving them. Of course, there will be new things that arrive to make things worse again. But as these things get resolved, the inflationary pressure that they're putting on the system will decrease, right? Like the war that's happening in Ukraine is obviously adding to inflation. The prices of anything related to that region have gone up. The prices of oil and gas and everything that we've already talked about, and electricity. So if that were to resolve, electricity costs come down, which means that factories can run more efficiently, which means they can lower prices, which means that inflation is actually in reverse for that sector. And it's the same for everything else that I mentioned. The same with supply chain. When people can deliver things more easily and more cheaply and more quickly, then that means that there are savings for the business, and then they pass on those savings to the consumer. And things start looking a bit more rosy again. So I think we're not as far away as we were. from the global financial crisis. And the other thing is that we learned an awful lot of lessons from the global financial crisis. You know, there were a lot of laws that were passed in the US especially, but in Europe as well, following the global financial crisis to make sure that markets were more resilient and much better able to handle what happened. So 3 years to me seems like it would be too long. It's a good question though. And yeah, I hope that helped. What's your opinion on the current state of the eToro Popular Investor Scheme? Someone's been watching Felix Falax, looking for a response to Felix Falax videos. Yeah, I mean, I think I'm in a pretty difficult position, right? Because eToro are definitely going to watch this and, you know, be listening very intently to what I say. That being said, I'm reasonably outspoken and sometimes I like to YOLO a little bit. So I will say that, yeah, to be honest, I think it's a video and I guess some of the criticisms that Andrew raised in the video are overdue. And you know, there have been some things like this, some things worse than others that have been going on for a while, and eToro needs that pressure on them to improve. And it's not that eToro is doing terrible. You know, there are plenty of fantastic investors on eToro, and you know, I copy some of them myself in a second portfolio. And I think, you know, the majority of copiers, you know, have at least some sense of what sounds too good to be true and what isn't, and you know, they can see through some of the mistakes that eToro have made. But I think, in my opinion, that they've made. I was just saying that to protect myself slightly from the wrath of eToro. Not that there's some like evil monster that's going to come and attack me for this. But yeah, you know, I think when you actually look at it from the whole, it's a pretty big innovation that eToro did with the Popular Investor Scheme. You know, there isn't really anywhere else that does it. There are some other copy trading websites, if you can call them that. They're tiny. They are far more risky. They're much less vetted. The amount of kind of technical stuff that has to happen in the background for eToro's system to handle all of the copiers and the liquidity and make sure that everyone's getting the same price and make sure that eToro themselves aren't exposed to too much risk if all of the popular investors are investing in the same thing. You know, all of these things, like it's a pretty complex service that they offer. So while I am not, you know, pleased to see some of the stuff that Felix highlighted, and you know, there's other stuff as well that isn't great about it. Like, we do have to kind of appreciate the fact that it is still a really, really cool service that they've built, and I think the majority of people do benefit from it. Like, if I was looking at it from an ethical perspective in terms of an investment or something, you know, I wouldn't be that concerned by it. Yes, they need to improve. I really hope they do, and I hope that Felix's video is the thing that kind of pushes them on that path. But you know, I'm not like super upset with them or anything. I just hope they improve it a bit, I guess. That's you know, that's what I can say with that, I guess. I'm kind of tempted to see what you guys are saying in relation to that. Are you public about which eToro investors you copy in your second portfolio? Yeah, no, I can't. I don't think I'm allowed to disclose that anymore. I used to have the portfolio public so that people could see it, but I'm not allowed to anymore, so I don't. There is much less money in that portfolio than in my main eToro portfolio as well, just to make sure that everyone kind of knows where my attention is. That's like a whole other bag of worms. I would add more funds to my main portfolio as well if I could. But obviously I can't do that because it would cause all sorts of disruption to copiers and to you know, my assets under copy and stuff. Right. Moving on. I was in Ukraine at the time. We were all shocked. Yeah. Can we cover Arrival and your view of the stock? Yeah, I actually um, at the weekend I saw the arrival van in flesh and touched it, which is actually something I guess I could even talk about to some extent. It's they use a very different material for the paneling of the vehicle, and for the chassis and everything. It's they use a lot of like these kind of synthetic hybrid materials that they kind of weave out of recycled plastic and other stuff that goes into it in some sort of secret mix. And it was really interesting actually just touching the vehicle because it kind of feels like plastic, and you knock on it and it's kind of it feels like it's quite lightweight, a bit like plastic as well, like normal plastic. But at the same time, it's kind of a bit cold to the touch and a bit more rigid and solid than plastic. But the van itself looked like really, really good, very impressive. They also had a speaker there that was on one of the panels, and I listened to him. And I mean, there wasn't that much to get from it because the event I was at was kind of targeted at just normal consumers rather than like investors who would ask slightly more probing questions. But it does sound like everything's pretty much on schedule and going well, and everyone seems happy, and like things are going to plan. They've got the agreement with First Group for the buses that should be hitting the UK very, very soon. The share price is down a ridiculous amount when you consider that basically nothing's really changed. People are obviously associating it with a lot of risk, but we just don't really know until their factory starts up how well this is going to go when the first micro factory goes online. They're projecting, I think, 600 vans for this year. I can't remember the number for the buses or if they even gave one. But the buses start production first. Should see that this quarter in Q2, hopefully, and start seeing them out and being tested by the people that want to buy them. So, and I think demand on the bus side of it, especially, is looking really, really good. And I think if they can execute on vans, they have a real opportunity considering the problems that Rivian is facing at the moment, because Rivian really is their biggest competitor in terms of like new movers in the space. The Fiat group that I've forgotten the name of that begins with an S, they have a pretty reasonable van out that's I think just come out or just about to come out. That's an EV. Ford are obviously working on the e-Transit. There are some other companies doing stuff in the space as well, but none of, I think Ram have got a van out in the US as well. But the range on them is all very bad. All of those are based off of existing models of vans, which means they haven't adjusted the chassis very much, if at all. They're using largely the same components, which means that they're heavier than they should be for an EV. The batteries aren't, and like the weight distribution is going to be off. I think that it looks to me like, in terms of getting to scale, where I was a bit concerned originally that Rivian would be much, much faster than Arrival, I'm not sure that's going to be the case now. So I'm pretty excited about seeing them ramp up and seeing how it goes. I think one of the best things in many ways is that because they're using a micro factory system, it's not like a whole massive factory with thousands of staff gets shut down while they try and figure out what's wrong and how to speed it up and how to improve quality. It's a tiny factory that's only meant to be producing a few vehicles a day. So while they are losing money every time they run into a hiccup, they're going to be losing a lot less money when they hit those speed bumps than a traditional auto company. So I wrote a big long post about Arrival on eToro as well. So if you haven't read it, then give it a read. Hopefully you're still here for that answer. I'm slowly catching up to where chat is. How much money you add to your portfolio monthly in percentage? I can't add any money to this portfolio monthly. That would be massively disruptive to copiers. So yeah, I can't. If I could add money, I probably wouldn't do it monthly, to be honest. I would probably do it quarterly or half yearly. I think that's generally a little bit easier for keeping track of how it's performing than necessarily doing it monthly. Although monthly isn't a bad thing either, though. You know, you can do monthly as well, but yeah, I don't really add any to it. I pay a lot of taxes, so a lot of my money just goes towards paying my taxes. And yeah, I would add money if I wasn't so restricted by the circumstances of being a popular investor, though. Maybe I need to like get an account to copy myself. That might be a bit easier. eToro, if you're listening. Thoughts on Stream Deck, both as a product and also inspiring the handheld market, perhaps. Stream Deck for the handheld market. I don't know how. Unless there's something I've missed from Corsair, unless Elgato have released a new Stream Deck that's also a console on the side, which I might have missed, to be honest, because there's been a lot going on. I mean, it's a good product. I love Elgato's products. I use a lot of them. I think Corsair did not, you know, I mean, I thought they were undervalued before their earnings. Yeah, they didn't do quite as well as people were expecting them to do in their latest earnings, but you know, I just recognize that it's a really, really, really good suite of products that they've got. They've been buying up companies left, right, and center, and doing a very good job at good valuations for those companies. If you look on Crunchbase, you can see some of the metrics for it. And yeah, I think that's one of the reasons I like them so much. I liked them actually years and years and years ago because I come from the gaming space, and I recognized how kind of shrewd their management team was in making very good decisions and expanding their product scope. And I think they're building a good customer base and a very, very strong brand and collection of brands as well underneath it, like Scuff, gaming pads and things. Yeah, I think they're in a good position. You know, the gaming market's only going to continue growing. I don't see it getting smaller anytime soon. The streaming market and this kind of like amateur video and content creation market is still growing. So all of the Elgato stuff's going to do really well. You know, Logitech really is basically their core competitor at this point. And you know, they're good as well. But I think, you know, if you're looking for something a bit more growth orientated as an investment, then Corsair's a better pick, even though they have suffered during the downturn. What do you think about Facebook? I'm almost inclined to skip it, but I'll give you a short answer, mainly because, you know, it's not really related to my portfolio that much or you know, this quarter or anything. But yeah, I think they've got a lot of costs coming up. You know, they're going to be hit by decreasing spend from advertisers. Actually, I think we even saw that in their earnings. And I think we saw that a bit in Google as well with YouTube. Yeah, they're going to be hit by decreasing spend from advertisers. I think the amount of money that they're going to have to spend to try and dominate the kind of NFT and metaverse space is vast, and I think they will lose to Microsoft. Similar to the question about Amazon, really, I just don't see much of a good reason to buy them instead of Microsoft. You know, Microsoft's provide all of these other services around it. Even if you look at some of the things they did, for example, with their flight simulator some time ago, that was running essentially running a game that was far too powerful to be run on normal computers. So they just used their Azure web services and things to run it instead, and demonstrated their technology. And when you consider that they've got the consoles and stuff as well, and you know, they were the people that did a lot of the investment and were really the first to market with a good augmented reality product in the HoloLens. They didn't really, you know, market it, and they didn't want to market it. It was more of kind of a fun experiment for them. But I think that Microsoft, if they decide that they want to go for that market, are going to be the people that win that market, not Facebook, and they will do it without spending anything like as much money. And let's not forget that Facebook also failed with Libra before, and that their vision is somewhat dystopian. And they take 50% of NFT sales for everything on the metaverse, supposedly, or they will be. Not to mention EU regulations, which are probably going to be preventing that by the time it's actually done. Recommendations on copper plays, I have absolutely no idea, I'm afraid. I've always been quite tempted to play copper. It's just an interesting market, and it's very related to a lot of the areas I invest in. But I am not an expert on mining companies whatsoever. I don't have any. Even some that I was very, very tempted by, like Rio Tinto, I was tempted by last year, and some of the companies around the steel sector I was very tempted by. Yeah, I don't think I'm the right person to ask, sorry. Okay, I've got to the bit where you're all considering what I said about eToro, I think. Yeah, did something happen with the sound or microphone? Can everybody hear him? Okay, good. I'm glad that's the case because I would only just have read that otherwise. Do you file your taxes yourself or hire people to do it? Yeah, I use other people mainly. One of them being my girlfriend, who happens to be quite good at that kind of thing. And trust me, my taxes are ludicrously just ludicrously complex. So I'm not going to pretend to even give tax advice. I just hope for the best and ask Leanne to help me fix it. Large flow of copy and money seems to be moving towards new PIs who are in profit for 2022 but have a short track record. Seeing lots of comments. eToro implying elite pros, including you, only perform well in bull market and should have seen this quote crash coming and sold, shorted, hedged, etc. What are your thoughts on this? You know, I've seen it quite a few times now. I do get it, right? Like it is difficult. When you're new to the space, I think you do come into it with this idea that you should always be able to make profit, or at least get to a point where you're not losing anything. But it really isn't that simple, and most people aren't investing looking at whatever thing is currently happening and trading based off of that. Like I didn't look at the war in Ukraine when it erupted and completely reassemble my portfolio. I definitely closed some positions and shuffled a few things around and reassessed some of the positions that I had. But like most investors don't do that because if you did that, you'd be doing it for all of the different events that happen. And if you think about the last 2 years, the sheer volume of these kind of big events that seem really big at the time that happened that you'll be adjusting your portfolio for, you would just end up with a portfolio that's eradicated by spread fees. And yeah, it's just you can't really trade quite that actively. And I'm someone who trades pretty actively most of the time, saying that. There are obviously ways that you can hedge it, and I could have hedged it more than I did, and I contemplated hedging it more than I did. But it's not like it's all risk free, right? Every time you open a hedge trade, and you're betting the market's going to go down, you're going to get hurt when it goes back up. So if you time it, it comes down to timing, right? And if you time it wrong, then you end up suffering on the way up. So then you don't make money in the bull market or in the bear market potentially. Maybe you just flat for the whole year. There are some events that I think are a bit more predictable. And where you can have an edge over the market if you're very specialized in a certain area. But realistically, they're pretty efficient. Like, the major big funds that are kind of working in these spaces, they're managing, hundreds of millions and billions of dollars. They have people that were former CEOs in car industries working alongside, a team of 10 other analysts to analyze the car industry. And so even if you are someone that thinks you know an awful lot about the car industry and that you can predict the impact that the Ukraine conflict is going to have on automakers faster and better than everyone else, you're probably still wrong. at the end of the day. And hedge funds themselves are specifically designed to hedge. That's why they're called hedge funds. When people say they're outperforming hedge fund managers, it's not saying anything all that special, because hedge funds aren't designed to necessarily outperform the markets. They're designed to hedge. So like Cathy Wood and such, to some extent, even you could argue the same thing. Maybe not quite so much for her actually, but yeah, it's the grass is always greener. But I think you've just got to actually really take a step back and think, okay, well, in the long time, if you're looking purely at this from a perspective of optimizing returns, what is the best way of investing? And in the long term, the best way of doing that is to be holding positions for long durations of time, to have a well-diversified portfolio, but not over-diversify, and to be exposed more to growth than to defensive stocks, and more to disruptive stocks than defensive stocks. Of course, the price that you pay for that is volatility. If you're someone that can't handle volatility, and you don't want to see red months and red years, then don't invest in those kind of portfolios. Invest in the safer stuff. And then there are good popular investors on eToro who do cover that kind of stuff. People like Slow and Steady, for example. They're good at managing that risk and offering you exposure to markets, and hopefully profits that will be larger than you would get from just a portfolio of bonds. But the end result is that they're still going to underperform the growth investors in the long term. So I guess that's how I would answer that. Yeah, some people will always follow what's currently profitable. Sadly, I think they're doomed to inevitably underperform as a result if you move around too much like that. Sasaki to a good team. Okay, I think I'm going to start wrapping things up. Let's see if there's a couple more questions. Did you watch the Berkshire annual shareholders meeting? What did you think about Buffett and Munger dismissive attitude about cryptocurrencies? Well, I mean, they say it every year pretty much. At this point, they say something negative about it, and that's fine. I didn't watch it, by the way, so I don't actually know the specifics of the comments that they made, but I believe it was Charlie that said it this time. I get it. I get it. Like, it's hard to see, especially like at the end of the day, we're a pretty long way now into this experiment of cryptocurrency, and we are still yet to see a lot of the kind of the fruits that were promised at the start. And the fruits that were promised have also changed over time. Originally it was meant to be a currency, and I think it's pretty clear that Bitcoin isn't a currency at this point, although there are still signs that it could be. When you look at what's going on in Latin America, El Salvador and such, with the Lightning Network and ETH2, if it ever launches, they do really hold an awful lot of potential to improve things. And I think actually DeFi is probably, in my opinion, one of the big success stories. And not even DeFi, CeFi actually, if anything, is the biggest success story. When you look at things like Crypto.com and Nexo and Celsius and BlockFi and all of these different things, in conjunction with what's going on with fintech, and you look at companies like Monzo and Revolut and Starling in the UK, and I'm sure there's equivalents elsewhere like Square and stuff. As much as those fintechs have been really disruptive to banking, I think CeFi has been even more disruptive. The fact is that you can take your stable currency of US dollars or euros, and you can go and change that into a stable coin, put it into something that, granted, is not FDIC insured in the US or insured by the FSCS in the UK, and you can earn a yield of 7, 8, 9% for essentially banking with those centralized cryptocurrency platforms, because they themselves are just cutting out a lot of middlemen, and maybe taking a few shortcuts on the way. But it's really disruptive, and I think DeFi is one of the things that shows real promise. I think some of the stuff around NFTs is I think most of NFTs is pure hype, but I think that NFTs have always held an awful lot of promise, and things like loyalty cards and reward points and stuff like that. I've always felt were going to be one of the biggest things to be impacted by crypto, and especially like in the gaming space as well. The idea of transferring your kind of assets between games and stuff, and not necessarily just losing everything when a game dies, and taking some of it with you. I think that's really appealing to a lot of people. It's just a shame that it's moved so far down the route of monetizing it, which is really turning games into jobs and stuff. But yeah, there's going to be a lot of people out there, especially asset managers and things from traditional finance that don't like cryptocurrency, and some of that will be because of a lack of understanding, and some of it will just be because of the kind of the school of economics that they believe in. You don't have to be an Austrian economics person to believe in cryptocurrency. I think universal basic income, automated taxation, like there's so many things that crypto can really help with in the long term, because it's so much more programmable and so much more open and transparent. Yeah, it's an exciting place to be. I don't have very much exposure to it at the moment, but yeah, obviously I disagree with their vision of what it is. But I'm a bit more in the middle, these days. I can see its flaws. I can also see the potential. How do you react to the fact that you're continuing to make money hand over fist through the eToro PI scheme, despite having a very poor portfolio that is losing people's money? Well, I react quite well to it because it arrives in my bank account, and I look at it and I think that's a lot of money, more than I ever thought I'd earn in most of my life. That's the honest opinion. No, that's just the start of my somewhat provocative answer. No, look, at the end of the day, as I said, I'm not a hedge fund. I'm not designed to hedge out all risk, right? I don't advertise myself as a hedge fund. I don't say, if you copy me, I promise you stable returns, or I don't say I will promise you returns even. I say that I will do my best to try and push for very high returns by taking risk, and there's a lot of people laughing, I think. Yeah, I run a portfolio that is risky, and I do my best to put out as much information as I can to make that very transparent to people, that there is risk, and if nothing else, I feel like people have hopefully learned more about what risk is, and that there is no such thing as high returns without taking risk. But at the end of the day, I still work for that money, right? I still have expenses and fees, and you could say the same thing about Tesla, right? You could have invested in Tesla for the first 4 or 5 years or 6 years, however long it was, up until 2018 or whenever it was that they made the first tiny bit of profit, and say, I've invested all this money in you. Why are you losing it? Why am I paying you anything? Well, you're paying them because they're still doing work, and it takes time to build, to actually get results for things. It takes time to build a factory and then build cars and get them up to a scale where they're doing well for you. It takes time for me to go and research stocks and then find ones I like and then deploy capital into them at the right time in the market, hopefully. It takes time for me to recognize when I make a mistake and to take money out of that position. And at the end of the day, my portfolio is still correlated to the markets. It used to be less correlated than it is now because I used to be slightly more aggressive in crypto and stuff. That is the result of me hedging. The reason I am more correlated with the market now is because I have reduced risk. And if I hadn't reduced risk, you would see my risk score at something like a risk 7 or a risk 8 right now, because markets are more volatile, and that's how eToro's risk score works. So yeah, it's a very long answer to your question. You probably already left, and you probably even potentially stopped listening, which is a shame if that's the case. But at the end of the day, you are paying, well, you're not even paying, but eToro is paying me for a service, and I do that service. I'm doing that service right now. I've spent 2 hours on this stream chatting to everyone, explaining my decision making, my thought process, my expectations, trying to be as transparent as possible, including the risks. And that's what that money is for. It really is that simple, I guess. Is it fair? That's another question. I'm a member of the Green Party. I'm not a hyper capitalist. So yeah, if you actually speak to Sam or some of the guys from eToro from a few years back, they'll tell you that I was one of the people that suggested putting a cap on salaries much lower than what I currently earn a long time ago. I'm not quite such a fan of that now, because I also realize how expensive it is with all the tools and everything else, and how much time I spend. But yeah, I guess take from that what you will. Hopefully you hopefully you take something from it. I don't want to lose people money. I want to make people money, and I think I've made people more money than I've lost them money. And if I haven't, yeah, that's a shame. But what can I do? I think you skipped the question regarding AMD. I didn't see a question about AMD. I probably did skip it. That does sound like something I may have done. Can't seem to find it. So if you want to ask it again, I'll try and answer it. Although I did say I was ending soon, so you're going to have to get it in quick. Someone's probably going to clip that little mini rant of mine. But I'm here very much listening. Yeah, well, I hope you understand it. How much have I made from the PI scheme? You asked for transparency. You're going to get if you think you're going to you're trolling someone who's not going to tell you, I'm afraid you're in for a disappointment, because I will tell you exactly how much I've made. So how much have you made from PI scheme since I'm down 18%? If you're down 18%, then I'm imagining that you must have copied right about when I was copy blocked. So that would have been February. So you would have been slightly behind my performance that year, so you wouldn't have made that much, and that would mean that you're down by more than 10% in total for your copy this year. So in 1 year and let's say 10 months, my eToro caps the payments. So the maximum you can earn is $150,000 a month, which is an awful lot of money. I know these are crazy numbers. Prepare yourselves. $150,000 a month. So that times what did we say? I can't remember how many months we said now. 20 months. Let's call it that. Make it easy. 20 months. So yeah, an awful lot of money. I mean, you're looking at like $3 million-ish maybe, something around there. From that, I have a tax rate of in excess of 50% effective tax rate. So half of that goes immediately, pretty much. Obviously, I'm not going to disclose everything about it. I have expenses of the equipment that I use, so the depreciation on all the stuff that I've got around me. I have paid people for numerous services, everything to do with website stuff and graphics. I've looked at and have in the past hired people to help with analysis, with video production, and things like that, and copywriting, and making sure that I'm writing good stuff, good content for everyone, and learn my lesson from that, because then then I lost a lot of copiers. I pay for about 15 or 20 different services relating to analysis, everything from TradingView, City Falcon, Seeking Alpha, Stockopedia, bill sheets. I don't know, like there's loads of them, and those add up to a pretty substantial amount. after a bit of time. There's costs in terms of like office space, in terms of going to events, all of that kind of stuff as well. So when you take out like the costs of my business as well, then maybe I end up with I don't know, let's say from that time period, probably maybe $900,000 or something. And then of course that's in dollars, so I take exchange rate volatility from that as well. So in terms of my local currency, it's a bit lower, so maybe closer to like $500,000 or something over that period. That's almost 2 years. So 250 grand a year maybe would be my take home pay. So yeah, it's an awful lot of money, an awful lot of money. But I do work for it. I try to at least. And I guess the other thing is I take an awful lot of risk for it. I quit my job that was pretty secure. That I was at the time I had just been promoted again. I'd been promoted numerous times through my career in that field. I gave up on all of that. I had a business project that I was working on with some friends. I couldn't really give the time to that I would have liked to. I had to give up on that. If you look at Wesley, for example, he was involved in a lot of startups, and he realized that he had to sacrifice those and focus on eToro if he really wanted to make it work, because it's a lot of responsibility. I have to study. I'm taking lots of courses and things, trying to improve. So I don't think it's it is expensive for what you get, I guess, but you're not paying for it. eToro is paying for it at the end of the day. So you could argue that you get better value from a popular investor like me than maybe other types of popular investors, and you can also argue that it's being subsidized by a lot of people who don't even copy people on eToro. So maybe someone just uses eToro to hold a bit of Bitcoin and things like that. They're helping pay for this as well. So you're getting it pretty cheap. And if you compare it to what you'd pay for, an actual active money management, or even just how much you pay for a financial advisor, a good financial advisor, or a family fund, or something like that, to look after not to look after your money, but to, they would be looking after it. I'm not directly looking after it. It's actually cheaper, quite a lot cheaper. And hey, I could always, say that I'm going to take 50% of profit after making vast returns on my cryptocurrency plans. That was a little bit tongue-in-cheek, I'm sorry. The last part. So yeah, there you go. I try to be transparent. You asked me a question. My girlfriend will be angry that I answered it and shortly tell me off, but I try my very best. And also, just for the record, just to add on top of it, when you think about it in terms of like tax and everything, I definitely make more money from investing than I do from eToro's payments. Would be the last thing. So I hope you do, Benville. I hope you do, and I'm glad to see that you weren't asking it in a really mean way, and I'm a little bit sorry that I semi trolled and semi got like a little bit passive aggressive in my defense, but it's most people who ask that question aren't asking it in such a nice way. I've had some mean things said to me over the years, so you have to have a thick skin. That's also that's also why I get paid the big bucks, to have a thick skin. Okay, I'm going to see if there's one more question, and then I'm going to end it because this has been going for 2 hours now. There is a full-on Q&A stream on Thursday, so if you want to ask any more questions, you're welcome to come back. I will have more time to answer questions. I won't be trying to rush through them quite as quickly. So yeah, you can either ask them on eToro, on my latest post, feed post, or you can ask them in the chat on Thursday as well. Both this and that Q&A will be uploaded to YouTube as well. if there are any more questions, then I'll answer it. If not, then we'll call it a day. That's before taxes, that number, the monthly number. Okay, it looks like there's nothing else. So thanks for... Oh, the Steam Deck thing. Okay, well, okay, just in time. Saved there by Leanne's comment. Answered the question about Stream Deck when it's actually about Steam. Oh, well, I'm sure it said deck afterwards. Steam, well, I mean, they're not publicly listed, which is unfortunate. I'm sure they run an incredibly lean operation. From what I recall, their numbers of staff that Steam have full time is in the low double digit. Well, not low double digits, high double digits, I guess by now. But yeah, I mean, they run a very efficient operation. Steam's in an interesting position, but to be honest, they're taking far too long to utilize it and to maximize it. They have been sitting on their laurels for too long. I think they're almost destined to be disrupted by Sony, both from their investments in things like Epic and Epic Games, and from obviously PlayStation and everything surrounding that, and from Microsoft, both of whom are increasingly buying more and more of the big content producers in the gaming industry. Obviously, Activision Blizzard being the most recent example, the most recent big example, because Sony did respond to that with an acquisition of their own, but nobody remembers who it was in comparison. Take-Two and everything else. But yeah, they released a Steam Deck. Okay, so that's what I've not seen. I'm imagining it's going to go down about as well as everything else that Steam's released. Sadly, although they have tried a few of these products now. They had the Steam controller. Before that, they had another Steam console that didn't really work. I'm guessing it's going to be another one of those. I'll take a look at it. Maybe it is good. I struggle to see it though, because at the end of the day, Steam is basically just a Windows/Linux/Apple application, and you could just buy a tablet if it's a handheld. And I'm imagining you could probably get a good tablet from Samsung that's going to be better quality and better components. Not necessarily, because I'm sure they'll partner with like AMD or Nvidia on graphics and things, but there's nothing then stopping Sony from doing similar. Sony can guarantee that they're going to sell more pretty much, so they'll always be able to put out a better product for cheaper, I think, than Steam will be able to. So yeah, I think it's going to be tough for Steam. But I haven't, in your defense and in Steam's defense, I have not explored it. So I'll take a look at it because it sounds interesting. I don't know how I missed it, to be honest, because I do play games. I guess I don't use Steam as much these days. Yeah, I'll have a look. Right, now we're really ending. Sorry for misreading your question before, and that's why I was so confused, because you said Steam Deck and I thought you meant Stream Deck, and I thought that was an odd thing to ask about so specifically. But now it makes more sense. Thanks for watching and attending, everyone. Very much appreciated. Always like a challenging question. I hope that Benville will continue, or Benville, I'm not sure how you pronounce it, will continue to copy me despite my extortionate fees. And yeah, be sure to come back on Thursday if you have more questions. Thanks, and I'll see you next quarter for the next update.